How the heck are you? It's Market Call. It's Tuesday, March 22nd. I'm Dan Nathan. Today, I am joined by Carter Braxton Worth of Worth Charting. You know him. He was on Market Call with us yesterday. He's filling in for Guy Adami, who is taking the day off. It's not because he doesn't love you. He's just got something really important to do. Today's Market Call is brought to you by CME Group, where risk meets opportunity, and of course, by Open Exchange, because they manage virtual meetings that matter. Carter Braxton Worth, welcome to a second consecutive day, easy for me to say, of Market Call. How are you, buddy?
That's right. The double header back to back. It's all good and lots going on as always.
So, maybe we'll do a day-night double header if our friends at Open Exchange could work that out for us. I mean, it's almost baseball season here, and I could care less about baseball season here, but let's talk about the markets because what's going on right now, you and I, we've been in the markets a long time, and obviously Guy, we talk about this a lot, is like that kind of whole notion of overshooting to the downside, overshooting to the upside. And if you have conviction about direction, that can be really hard on days like today. We've had this kind of steady march higher since we had that Fed rate hike, the first time since 2019, which was very well telegraphed. Markets sold off into it. The stock market, rates rallied into it. We saw commodities rallying into it. And now we're seeing a bit of a reversal. What's your take here? I know we talked a little bit about the same thing yesterday, but here we are right now with the S&P up 1%, the Nasdaq up 1.5%. What's your take here?
Right, so the almost unanswerable question, or the million-dollar question, is it the current strength, a rally in a bear market, or is it the beginning of a more enduring move higher, which is to say that the lows are in and that one is right to be more aggressive on the long side? And I can speak for myself, but I think frankly I'm speaking for anyone who wants to be candid and sort of forthright. Nobody knows.
Yeah.
Nobody, come on. And maybe some of the gods know. Who's that?
Yeah.
The gods being George Soros or some of the great titans. But at the end of the day, they don't know either. So we're all in the dark. We use our tools. We look at certain technical indicators. We look at levels. People track sentiment. And then from there, you take your chances. At the end of the day, what we do know is, obviously, 1 week ago, the damage done to not so much the indices themselves, but to the average rank and file stock was substantial.
Yeah.
Consider this a statistic that we've discussed before together, right here on this sort of in this venue. The Russell 3000 is the most broad aggregate we have, representing 98% of the investable capital in the United States. And just as of last Friday, 46%, so let's call that 51 out of 2 of all stocks in the index had lost 30% of their value. A third had lost 40%. And so the bull could say we had our bear internally, however you want to call it, and that it therefore was due for this kind of washout, a bounce. The bear would say, can you really fix it? 2 years of excess with a 12-week, 15% sell-off in the S&P.
Yeah.
That's it. And that's where we stand. And nobody knows the answer. Only price will help us figure it out.
Well, that's the $30 trillion question. We're going to drill down in the S&P and the Nasdaq in a couple minutes here, but we got to start to figure out the stock market. You got to figure out what's going on with yields here. And again, like we just said, this was telegraphed, that rate hike. And what I think surprised some investors yesterday was when Fed Chair Powell, just days after their meeting last week, where they did have that first rate increase, suggesting that they are going to take the necessary steps to, obviously, to combat inflation. So all of a sudden, if you look at that CME FedWatch tool, it's pricing in at the next meeting, a strong likelihood of a 50 basis point hike here. And I think that's really interesting when you consider the fact that, our last rate hiking cycles that we were in post the financial crisis, we got very used to these 25 basis point hikes every other meeting, that sort of thing. It was kind of set it and forget it here. Now Goldman is saying that they see the Fed hiking by a half point at the next next two meetings. So let's just talk a little bit about those expectations. They will move around. If you remember, prior to this meeting that we just had in March, when inflation readings were running really hot, at one point we did see the probability of a 50 basis point hike in March. It was over 50%. That obviously came in kind of hard once the war started. And that is the push and pull I think that the Fed is going to have to deal with, is like the forces of inflation that were left over from the pandemic versus the ones that are actually being amplified now by the war and the potential for that to de-escalate.
Right. I mean, one thing to say, and we were just talking about nobody knows. Let's be frank about this as well. There's this great insight imputed to the Federal Reserve, the individuals, the men and women that are there, or at the Treasury. Now, just to be clear, we see this all the time. Apparently there was transitory inflation, don't worry. And now all of a sudden, from the so-called experts, it's not their fault. They're just humans who put pants on in the morning or shirts on, or whatever it is, skirts, dress. They don't have a clue. Let's remember, in 2008, we were deteriorating badly. Hank Paulson, a former Goldman head, and then a government official said, we don't see any problems. How about the rating agencies? Just to be clear, couldn't find their glasses. Never downgraded a single company in 2008 until at the bottom. I mean, it's just people like us here trying to figure it out. Because they have these roles, it doesn't make them any brighter, any smarter, and even worse, some of them are academics who've never held a paying job.
Yeah. Well, I think your point is a good one. I mean, obviously they see a lot more data than the average citizen investing in any market here. It's just the way that they impute that data and the kind of messaging that they have about it, going back to the final financial crisis. I'd like to think that Hank Paulson knew that we had an unholy problem here. He just didn't want to kind of yell fire in a movie theater a little bit here. But Carter, let's look at yields here, because the move that we've seen, in the 10-year U.S. Treasury yield has been pretty extraordinary in the last few weeks or so. And this is just telling you that market participants in the Treasury market just believe the Fed, that they are going to be aggressive in raising rates. And we talked yesterday about the inverted or the potential for the 210s to invert and what that might mean as it relates to a recession. But let's talk about the 10-year yield, because this is the one that I think most investors are really focused on here. And I'd love to get your take after such a sharp move.
Right. So as it relates to the cost, let's take 30-year fixed mortgages are now at 4.5, up from 2.87. It starts to bite at some point. But if you look at this chart, which is simply the yield chart, and there are no lines, no judgments by me or anyone. Now let's look at the next one. Let's go back and forth. There are the lines. Now those aren't manipulated. Those are mathematically parallel trend lines. And just as we've ricocheted to the penny off the bottom, we have rallied right to the top. Are yields a little stretched here day to day? Sure. Could one buy some TLT, that's the iShares, trade it for a bounce? I think so. It would come a long way.
Yeah, so let's talk. I mean, that chart, I mean, that's pretty obvious. As you say, to the penny here, I mean, it could continue to break out if the Fed were to get a bit more aggressive. Inflation readings, get that much hotter here. But to your point, we're at 40-year highs. We know that all the situations, that the Fed are looking at, the level of uncertainty about the war is clearly the one thing that is a bit of a monkey wrench here. But Carter, let me ask you this. I mean, what if we were to see, and we're not seeing that just yet, and I don't believe stocks are rallying and really kind of pricing this in yet. What if we were start to see a bunch of disappointing earnings here in the U.S.? What if we were start to see a lot of disappointing economic data? Might that be the trigger for yields to come back in and starting to suggest that we could be in a stagflationary environment?
Yeah, sure. I mean, if you don't have follow through, whether it's payrolls or whether it's earnings in the S&P, if you don't have follow through, you're going to ultimately see some give back in yields. That would be inevitable. The day-to-day is stretched, right? It's excessive. Excessive moves down, there's mean reversion. Excessive move up, there's mean reversion.
Yeah, I guess, in the height of the uncertainty about the invasion of Russia into Ukraine, about a month and a half ago, we saw the 10-year U.S. Treasury yield get as low as 163. And I think it was pricing in a flight to quality as investors, moved into U.S. Treasuries, but also the potential for slower growth because of that. And so, that's the one that's going to play out over the course of this year. But I like that call. I think it seems like rightly contrarian at the moment. Speaking of rightly contrarian, I don't even know if I'm using those two words correctly, but David Rosenberg, who you and I both know and like a great deal of Rosenberg research, he had this tweet earlier today, and I think this is kind of interesting, and it's a good segue to the stock market here. He said we can take the N out of TINA, and TINA stands for there is no alternative. That's something you used to hear a lot when yields were really low for a very long period of time, with the yield on the 10-year T-note now 100 basis points greater than the S&P 500 dividend yield. We haven't seen that since December 2018, which got corrected with a 32 basis point T-note yield meltdown and a 9% stock market meltdown. And he's referring to that period where the 10-year U.S. Treasury yield got above 3% for the first time in over a decade, right? From prior to the financial crisis. And we saw the stock market sell off 20% in about 2.5 months or so. And it took the Fed doing a massive about face, getting very dovish, right? The irony is that in 2019, and we talked about it yesterday in the market call, that's when the yield curve inverted, right? In the summer of 2019. And we did get a recession. Now, granted, it was a black swan sort of event. What do you make of this tweet? If you can take the N, which is the no in the alternative part, what do you do with this here, man? Because rates going higher, it does make S&P stocks look less interesting.
Sure. So the whole CAPM model, right, all dividend discount models, all discounted cash flow models are based on a risk-free rate of return. And then you try to extrapolate earnings growth, assign a multiple, et cetera, and so forth. The unknown is always what is the risk-free rate? How do you handicap that? And basically the bottom line here is if and as rates go higher, at some point equities have to be re-rated lower. Yeah. The question is, with all of those models, is they're essentially based on rates at generally higher levels, that it's still a very low cost of capital, right? They're at 30-year money at 3%, 10-year money at 2.3, 2.4 is still low. We shall see. My hunch is that it can't take much more, but for today, the S&P markets in general are accepting this current new move to 2.3.
Yeah. And that's a really important point. I mean, listen, markets at any point are pricing in the available, kind of data that they have here. And so, with that kind of comment from Powell yesterday, and now Wall Street, strategists kind of getting on board for the potential of faster than expected rate hikes, the stock market, the S&P 500 is down 5.5% on the year, Carter. Okay. Does that make, a whole heck of a lot of sense when you consider it was up 26% with all of the help from all the monetary and all the fiscal stimulus last year and the rebound after the year before where we got the vaccines, right? And people started pricing in the potential for a reopen. And I know you have some charts, the S&P futures here. It just seems really kind of odd to me. We've had this sharp rally. At the lows, the S&P was down about 15% from its highs. But again, it doesn't seem like enough time has passed to say that was it.
Yes, and that's why this is, and you got people making big bets both ways. But what we do know, let's just characterize it for what it is, a steep and steady advance, a major give back, correction, dip, drawdown, sell-off, doesn't matter the nomenclature, of 14.5%, 22 on the Nasdaq. And now an important, albeit young, 6 sessions, an important ricochet. And the ricochet, the bounce, leaves the S&P, the futures, which you're looking at right here, right back to 150-day moving average, which is now flat. Right, so it's a rally to a difficult level where overhead supply comes into play.
Yeah, and I guess the thing, it's funny that you say that people are making big bets. And so I guess the question is like how convicted they are. What's different this time about buying the dip, as the kids say, is that, when you think about, what's different about buying a market that's sold off 15%, the S&P 500, NASDAQ 22%, given all of the uncertainty we have, the difference is that we are literally kind of start this quantitative tightening period. That's just, again, when the market started rallying in January of 2019, it did it because the Fed had a pivot towards a very dovish sort of manner here. So I'm curious to your longer term take on the S&P futures here, because I know you brought a couple charts here, and at this point, when to me it makes no sense on a fundamental basis, where the pace in which rates are rising, the uncertainty we have about economic growth, the level of inflation, I like to look to the charts a little bit. That's why I follow you a great deal there, Carter.
Yeah, and it's one of many tools. For me, it's the only tool, right? I don't do fundamentals anymore. Did it for years and abandoned all of that. But what we know, again, and the move from the pandemic low to the highs of Jan 4 this year, and then this correction, and now this ricochet, it would leave the market at a level where I would say, at a minimum, if one bought well or added well 2 weeks ago, 1 week ago, you take some of that off, right? If one doesn't do much anyway, movement, you write some calls against your positions. But the sequence of a massive collapse, news-related, of course, a pandemic, an equally impressive recovery and massive move to new all-time highs, also news-related, government-induced, and then a crack like this where basically half of all stocks lose 30% of their value or thereabouts, and then a ricochet. That sequence, as I just described, it leaves the market at a difficult level. And taking measures or taking advantage of the recovery, the bounce, makes sense to me.
Yeah, here's a question I have from a viewer right now from Tees Trade, TEES Trade here. What early sign would you look for to be able to tell if this is a bear market rally versus a true change in trend? And that's a really good question, Carter. My quick question to you, as possibly an answer to this, is that when I look at that chart that you just posted there, the series of lows that we made in January, February, we didn't make a new one in March, which you mentioned yesterday on the market call, but those lows were below last year's that last low that we had before the market took off to a new high in the fall. Does that help answer that question, making a new series of lows? So for instance, if we were to go back and take out the March and the February lows, then that was obviously just a bear market rally.
Right. So we went lower than those September, October lows. But the sequence on a shorter term basis has been interrupted. We're not coming from a new low right now. This current rally started from a higher low, the higher than the Feb 24th low. So those plunge lows you see, that's Jan 24. We made a new low exactly a month later, Feb 24. And then this rally, which is now up against the 100-day average, has not come from a new low. It's not enough to suggest that the sequence changed, but it has to be noted.
Yeah. Here's a good question from Robert Byers from Twitter here. He says, typically, how long do cyclical bear markets last during secular bull markets? Now, here's what I think you and I would both agree, that we're clearly in a secular bull market, okay, right? And unless something is totally broken, and could something be totally broken and I don't like to use this, kind of term lightly, if there was a world war, if there was a, massive disconnect between the access to kind of commodities and food and, supply chains and all that sort of stuff. That would obviously break what I would think would be a bull market cycle in equities and like here. But for me, what I think is interesting is that time, okay, and you and I kind of addressed this a little bit. The question is about time, and I go back to the highs were put in March of 2000 in the S&P and the Nasdaq. We didn't bottom out until October of 02. The highs were put in November of 2007 in the major indices in the financial crisis or into it, and they didn't bottom until April of 09. And which is why I don't look at the pandemic. I think about all the stimulus that we had. That doesn't really kind of line up if you think about we had a very short bear market. So I'm curious, how do you think about time in this scenario? Because like you said, we had a lot of damage done in a very short period of time, but given the rate environment we're in and all the uncertainty, it doesn't seem to make a whole heck of a lot of sense that we're done yet.
Right. So again, the whole notion of 20% is a bear market, nowhere is that written. I've spent my life looking for it. It was made up one day, someone made it up and it stuck, right? So what we know is there is a definition of a bear market per se. 1987 was not a bear market. Yes, S&P was down 30+%, but it ended up on the year. meaning if you have a crash like that, it's huge loss of capital. And again, down 30% for the indices. One could say, how could you not call it a bear market? But it's no different than the pandemic. 87 was an event. The pandemic was an event. A bear market definitionally is duration based. And we have had 4 epic ones. We've had of course, the .com, right? 2000, 2002. We've had the financial crisis, 2007, 2009. We had 73, 74, a real doozy. That was 2 full years. All of 73, all of 74 down 50%. And of course, the depression. And the point is that at this point, is it still a secular bull from the financial crisis low of 09? Sure, but these are just words, right? At the end of the day, it's about making money. And if one is in Peloton or Zoom or DocuSign, bear market, bull market, hey, I just lost a fortune if I bought it at the high. It's more important to try to make money, figure out which patterns are going to be good. But as it relates to the academic, and it's a perfectly valid question, secular bull, fine. We've been in a secular bull market since the 09 low. Is this a bear market or is it a news event? We ricocheted, we sold off, government fixed it. It's all of that. Here's the most interesting of all, and this is long-term. I don't play long-term. That's not my period. I'm an intermediate player. I'm not short-term day-to-day, but the long-term question is, what are the returns available to the equity market looking out, over a decade? Now, the reason I don't do that, because you could be dead in a decade, who knows? But the long cycle people do talk about that. And almost to a woman, they say returns will be muted.
Yeah. All right. Let's look at the Nasdaq 100, the futures here, the trade on the CME, because this is one where, for me, a large part of my career is based on the trajectory of the Nasdaq 100. I started covering tech in 1997 at a hedge fund and traded all through that bear market you just mentioned, the post.com. So I still have a lot of scar tissue, Carter, from that. But when I look at this chart that you have going back to 09 in the Nasdaq 100 futures here, man, I see that uptrend all the way down there near 10,000. And, we obviously got above the upper end of that band here a little bit. But if it were rejected at that higher band, where is your target to the downside in the Nasdaq 100?
Right. So it's a fun chart, right? First of all, again, mathematically parallel lines. And we know that the excess off of the pandemic low allowed this index to move above the upper band, excess. And now we've corrected, sold off back into the channel. And this rally, I think what you're implying in is if and as it were to get back to the underside of the upper band, that's a key level to watch. More often than not, when you do that, you struggle.
Yeah. All right. Well, I mean, that to me, rejection there. And I think you just kind of have to sell rallies until you see something that looks like 12,000. But that's me, and that's my bearish self. Here's one that's been a great trader, Carter. You've actually had a couple of really great calls on oil. And, the most recent one is you thought that was clearly a blow off top. You nearly called it to the day. We have the NYMEX oil futures going back to 2003. So almost 20 years, encapsulates that, that massive decline we had during the financial crisis, the massive decline that we had when the Fed came off ZERP and QE in 14, 15 into the lows in 16, and obviously everything in the pandemic here. What's your take on this one here? There's obviously that overshoot that we saw during the financial crisis, maybe an overshoot that we just saw. Where would your target be if we were to stay below those 2011, 12, 13 highs? Where would your target be on the downside?
Right. So one could say I drew the line arbitrarily, and to some extent that's fair. But what I was trying to do here is to capture the meat of the range. So there are moments of excess up or down. Obviously, crude went negative $30 a barrel. How do you even chart that, right? But what we do know is we're back at basically the upper range. And so you see annotated there, 115 a barrel plus minus, and then at the lows, 32 a barrel. At this point, my hunch is that the move and collapse of the past 4 weeks, 130 a barrel, close to it, that those highs will stand as important highs, and that actually crude is sort of where it belongs, and that there isn't any discernible trade one way or the other here.
Yeah. All right. Well, listen, I don't really, like you say, you only look at the technicals and you don't really care about the fundamentals. Here's one, the COMEX gold futures. Okay. Like, I don't know what the fundamentals are for gold. I know there's some industrial uses for it. I know that there's some parts of the world who find it very fashionable, not me. But this is kind of an interesting chart. Our main man, Guy Adami, has been a long-standing bull on this one. What does this look like to you? Are we banging up against resistance or is it making a bullish flag here?
Well, I think it's the latter, but what's important is that we have a well-defined level, and gold continues to try to break out. And one could say, well, this is a failed breakout. It's way too early to make that conclusion. What we do know, unlike oil, of course, it was able to make a new all-time high. And the pullback is perfectly reasonable to my eye. So a much different formation, much different pattern. And my inclination is to step in and buy weakness.
Okay. All right, cool. Hey, listen, we got to start the hustle. Guy usually does a better time on the clock here than I do, Carter, but there's a couple things in the stock market that I want to hit really quickly here. I want to move ahead to the BKX. This is the banking index here. And I'm not using XLF because I didn't want Berkshire, which is the highest weighted stock in the ETF that tracks the bankings, but oddly has Berkshire in there. Give me your quick take on the BKX. Last night on CNBC's Fast Money, I did this little bit on JP Morgan versus Wells Fargo. JP Morgan showing worse relative strength of late than Wells, which is up on the year. Now it's up 11% on the year, while I think at its lows just recently, JPM was down a little more than 20% or so. I'm just curious your take on the banks, because JP Morgan, obviously the exposure overseas, the unquantifiable exposure to what a global recession might look like, or what's going on in Europe in particular, whereas Wells Fargo has no international exposure, but they're very exposed to U.S. consumers and housing.
That's right. And one way to capture that theme, just what you're saying, who has exposure, who doesn't, or who's in a better position, is the KRE, right, which is the regional bank index, which is very domestic, doesn't care to some extent or a large extent about currencies, about oil, about war, and so forth. And so a pair straight here that comes to mind from my seat is KRE long, BKX short, whereas money center banks, Citi and JP and others are quite burdened. And there are some idiosyncratic, whether it's US Bank or PNC, which act a lot better.
Yeah, so I drew the charts here. Yours are much better looking than mine, and they probably have much more precise levels here. I do think it's interesting that BKX is right there at your 150-day moving average. So let's see if that is technical resistance. I want to quickly go to JP Morgan, though, because look at this one. I drew a downtrend, and what I think is really important from that 170 level, Carter, that was the day that the company reported Q4 earnings. I know you don't care about things like earnings and guidance, but investors cared about their expenses in the quarter. And you saw that was a big gap for a big money center bank on just a piece of earnings news here. You see the series of lower highs and lower lows, and it's right back at that downtrend. What's your take on JP right here?
Just as you've characterized it. So the sequencing is obvious or clear to the eye, a well-defined series of lower highs and lower lows. And so this counter trend move, we're in a downtrend. This counter trend move up is about where one would expect the strength to abate. So if one were long, you sell calls. If one is a trader, you take the money and run. And if one's really short term, you bet short here for a pullback.
Yeah, I like that. And be playing for like that 127, maybe a retest of those recent lows. What about Wells Fargo? This thing looks very different to me. This looks much more sideways, if you will, right? And had that break above, what was a breakout level from early January. It held that 150-day over the last couple of days, and you're seeing, outperformance. I'm just curious. My take on Fast Money last night was like, keep an eye on this one, because this may be a better barometer. If you're talking about stagflation, specifically in America, here, because of their lending and their mortgages and their exposure to U.S. consumers, this might be a better tell near term.
Well, if you did a ratio chart of the two, of course, it would be off the charts. Wells is handily outperforming JP Morgan. And so if given just the choice of one versus the other, I would much rather be in Wells.
Okay, cool. And that makes total sense to me here. And I just want to rip through this one. Last week, you had a major call, a technical call. I was on vacation, but I did see the tweet, and you said this is how a bottom is made, and you basically charted square here. You see that really sharp downtrend from late November is obviously traded as high as, I don't know, 290 or something like that last year. It got as low as like 90 some dollars, late in February here. Beautiful move. I mean, literally, you think about that. What is that, like a 60% rally? But it's still down 55% from those highs. So you called it correctly here. Maybe sees a little resistance at 150. I don't know. What's your take?
I mean, I think so. Again, if you just think about sort of the ebbs and flows, the sequencing, you're a little ahead of yourself day to day.
Yeah.
The broader thrust is that it's putting in a bottom that's likely to be an important bottom and acting differently than stocks that one could consider similar, a Peloton or a Zoom,
Yeah.
and so for DocuSign.
All right, well, that's a really great point. So stocks that you would consider trading similarly. Let's look at PayPal, often compared as a very similar sort of company. Look at the chart that I drew here. This is from January 2021 here. It has not broken that downtrend just yet. And so would you say, and it's obviously had a really healthy move, I think that low was $92, and here we are at 118. Is this thing something that you'd look to fade if it were to get to that downtrend in the next couple days?
I think that's exactly right. So when you first approach an identifiable level of overhead supply or a channel, you make the bet in principle that it will falter there, either back and fill, not continue higher, or back away. Yes.
All right, so the last one I want to look at right here is Roku. Again, this is a stock that traded $4.90. It traded as low as, I don't know, $100 just last week or so. This one is above, and this is a pretty precise line. This is just above that downtrend here. So 100 to 124. It looks like an amazing 24% rally. I can even do that math, Carter. But what would you play for this one? Is this one a move back to 150, basically fill in that gap from February that was on earnings?
I think that's reasonable. And again, one could say, okay, so you drew a line, big deal. Carter drew a line, Dan drew a line, but we have to do something, right? What are we going to rely on the PE for this? Of course not. Whereas price to book, that's out the window. So can we try to discern the beginnings of a bottom? It's often right to be late. Let it continue to develop, miss some of the move. But the inclination here is to get in motion, small on the long side, and play for higher prices.
All right, man. Well, listen, that was great. I really appreciate it. And I think it's important to kind of refresh your call on the square, but also show a couple stocks that have had similar percentage moves to the downside and how they can actually look differently to your eyes. So we appreciate that. I also appreciate you filling in for Guy here today, Carter. It's always my pleasure to talk to you. I mean, I love talking charts with you, but I really like talking markets away from the charts there too.
And everyone needs a day off or whatever it is that Guy's doing.
No, he's working, buddy. You know he is. All right, well, that's going to do it for today's market call. Thanks again to our sponsors, CME Group and Open Exchange. So if you like what you saw, be sure to tune in tomorrow. We'll be back the same time, same place. Guy will be back. We'll see you then. Thank you very much, Carter.
Bye.